There are three basic areas of accounting. There's financial accounting. I like to say that answers the question, how did you do? There's managerial accounting. I like to say that answers the question, how are we doing? And there's tax accounting that talks about what is our fair share of income taxes. The first class we usually talk about is financial accounting. How did you do? Our accounting education usually begins with financial accounting. I say we're answering the question, how did you do? Because we're preparing for financial statements primarily with outsiders in mind. We're trying to tell rating agencies, we're trying to tell the SEC, we're trying to tell prospective investors how we did the last period. The four statements are the income statement, that's our report card. Did we make money or lose money? Then there's the statement of retained earnings. If we did have earnings, if we did make money, did we retain it in our company or did we pay it out to our shareholders in the form of dividends? Those two statements, the income statement and the statement of retained earnings, cover a period of time. The balance sheet is a snapshot at a moment in time. As of the end of our fiscal year, what did we own? Those are called assets. What did we owe? Those are called liabilities. And the difference between what we own and what we owe is our equity. Those first three statements come from the accounting cycle. The last statement is a statement of cash flows that explains to the outside world what happened to our cash balance. For example, if Microsoft made $72 billion in net income, why didn't their cash just go up by $72 billion? Well, the answer is they may have invested in some buildings, they may have invested in some software, they may have paid back some money that they owed to other folks. So the statement of cash flows explains what happened to the cash balance over the course of the year. All right, let's look at each of these quickly. The income statement is our report card. Did we make money or did we lose money? Microsoft, for the year ended June 30th, 2022, made money. They made $72 billion. They had total revenue means sales, of $198 billion, and they had the cost of the goods that they sold. In other words, they either bought these things or they made these things that they sold, and those cost of those goods sold is 62,650 million. You subtract sales minus cost of goods sold gives you gross margin. That's the markup. But there are also operating expenses. So gross margin minus operating expenses gives us income from operation. And that's what we're going to look at in managerial accounting. We're going to spend a lot of energy helping management maximize income from operations, or as we might call it, operating income. Then on the income statement, we add and subtract other things like interest and dividend income, interest expense, and other income and expenses. Then we'll have income before taxes minus taxes gives us net income. This is our report card. Did we make money or did we lose money over the last year? If we did make money, did we retain it in our business to invest it in new assets, to pay off old debts, or did we distribute it to our shareholders in the form of dividends? That's what we learned from the statement of retained earnings. Retained earnings at the beginning of the period plus net income minus dividends gives us retained earnings at the end. And that retained earnings at the end is what appears on our balance sheet. The third financial statement we produce to answer the question, how did you do, is called the balance sheet. Whereas the income statement and the statement of retained earnings cover the whole period, the balance sheet is a snapshot as of the last day of the period. What do we own? Those are assets. What do we owe? Those are liabilities. And the difference between what we own and what we owe is our equity in the business. Assets are things like cash, marketable securities, those are stocks and bonds of other companies. Accounts receivable, that means customers owe us some money, they just haven't paid us yet. Inventories are things that we hold that we're going to sell to our customers. If we're a manufacturer, we have three kinds of inventory: stuff we're going to work on, stuff we're working on, and stuff we're finished working on. Long-term investments, would be investments in stocks or other companies that we plan to hold for the long term. Property, plant, and equipment is another class of assets. It's land, building, and equipment, less accumulated depreciation. Depreciation expense is the way we spread out the cost of a fixed asset, like property, plant, and equipment, over its useful life. Accumulated simply means total. So we can see that Microsoft has written off $59 billion of its assets so far. Intangible and other non-current assets are things like patents and trademarks. Assets are things that we own. Liabilities are things that we owe. Any account that has the word payable, unearned, or accrued in it is a liability account and means we owe somebody some money. The difference between what we own and what we owe is our equity in the business. The first three statements we prepare in answer to the question, how did you do, are products of the accounting cycle. The fourth one is the statement of cash flows, and we create that by looking at our income statement and our balance sheet. For example, if Microsoft made $72 billion in net income during the year, why doesn't their cash simply go up by $72 billion? In point of fact, their cash goes down by $293 million, and the statement of cash flows explains how. We break it down by operating, investing, and financing activities. Olive is funny. An example of an operating activity might be that customers from the previous year finally paid us some money they owed us from that year, and it came in during this year. So we have more cash than you might think looking at our income statement for this year. An example of investing activities might be we purchased some buildings. Those monies don't hit our income statement until we depreciate them. So we have less cash than you might think by looking at our income statement. Financing activity might be the payment of dividends or the repayment of previous debt. Those items don't show up on the income statement, so we would have less cash than you would think when you look at our net income. So the statement of cash flows explains to the outside world what happened to our cash balance over the course of the year.